Australia's struggling retailers have been given a much-needed boost. A new report is forecasting solid sales growth next year thanks to interest rate cuts and federal government handouts. But as Neil Woolridge reports, the big department stores are still expected to face tough times.
The retail pulse remains weak, but slowly a few more signs of life are returning.
The foundations for retail in the next year are probably the best they've been in 3 years.
Sales growth fell to a two-decade low of 0.7% last financial year, but Deloitte Access Economics is forecasting that will rise to 2% this year and 3% in the next.
Previously, we've seen trend growth in retail of about 4% over the 90s and 2000s, but really a lot of that was built on the base of strong house price growth, strong share market growth, encouraging people to borrow more.
So David Rumbans argues without those stimulants, 3% growth next year is a more normal level. Deloitte says interest rate cuts and federal government payments to families will help, but consumers and businesses are still wary about the global economy.
We're seeing that consumer confidence is still quite low. So even if Australia is shielded to a degree, we may see that those income gains are then not spent at the shops. We may see the savings rate go up again.
And while sales of food at supermarkets, restaurants and cafes are forecast to grow strongly, the outlook for department stores remains bleak.
I don't see 3% growth in discretionary retail in the next year and perhaps a year on. This is a tough market and it isn't going to improve overnight.
Turnover at department stores has fallen by 3% in the past year. Retail analysts warn the major chains like Myer and David Jones have become victims of their own discounting and a much more savvy consumer.
At this point, it's difficult to see how incremental share is going to come from smaller providers. It will have to come from their direct competition. Now, in that environment, if you pursue market share gain against someone of equal market power, then your ability to do that profitably is very hard to see.
Don O'Sullivan says Myer and David Jones' oligopoly power has also meant they haven't had to keep pace with online retail like others have in the US and Europe.
I'd be surprised if the management teams themselves were thinking any different on that. And I think many of them have made comments to that effect, that they're looking to up their game.
Booney Brooks says the long-term outlook will stay challenging for bricks and mortar retail, and over coming years that will mean smaller stores and fewer of them.
There's no doubt that a lot of small stores are hurting, a lot of small chains are hurting, and we are going to see a greater number of them move into either receivership or administration.
He argues the best way to describe Myer at the moment is the best of a bad bunch. Hardly a ringing endorsement, but perhaps enough to keep its main rival at bay for now.